Okay, let's dive right into this explainer with a scene that absolutely shocked the entire world. I want you to imagine, just for a second, waking up, putting on your best suit, and heading out into the brisk morning air for what you think is a completely, totally normal Monday. You grab your coffee from the usual spot on the corner, you swipe your badge at the turnstile, and you ride the elevator up to your floor, completely and utterly clueless about the absolute nightmare waiting for you. For 28,000 employees, this ordinary, mundane routine shattered in an instant. They walked into their building expecting to analyze spreadsheets, pitch clients, and trade securities like they did every single day. But instead, they were met by stony-faced security guards handing out empty cardboard boxes. Whatever happened to them that morning was kept a complete, airtight mystery from the rank and file until the very last possible second. So we're going to build up the drama of this incredible corporate thriller step by step to uncover exactly how this disaster unfolded. Just picture arriving at work. You look up at the glowing TV monitors above the trading floor, and you find out from the morning news, the news, not your boss, that your firm, literally your entire livelihood, is completely dead. People were openly weeping. They were paralyzed by shock. Suddenly you're forced to pack up your desk, your family photos, your coffee mugs, into a flimsy little cardboard box. And as you take that long, claustrophobic walk out the heavy glass front doors, there's this massive crowd of tourists and reporters just standing there, snapping photos of your tears as if you're some kind of morbid roadside attraction. It was a day of unimaginable, visceral shock.
And really, this brings us to the core mystery we are unraveling today. How in the world does a 158-year-old financial titan, an absolute behemoth of Wall Street holding an astonishing $639 billion in assets, just vanish overnight? Poof, gone. How does an institution woven so deeply into the fabric of American financial history collapse in absolute secrecy, leaving its own dedicated employees entirely blindsided? Well, to figure out this thriller, we have to look past the flashing cameras and understand the incredibly complex financial machinery that was operating behind completely closed doors.
Section 1. A century of steady growth. The illusion of security.
To truly understand the sheer shock of that Monday morning, we really have to look back at an incredibly stable past. This was a company that gave everyone, investors, regulators, and its own employees, a total false sense of security. They actually started way back in 1844 as a humble little dry goods store in Alabama, founded by Henry Lehman. From selling cotton, they grew into a global powerhouse. They survived the brutal railroad bankruptcies of the 1800s, they weathered the Great Depression in the 1930s, they even survived 2 world wars, and by 1994 they were spun off from American Express in a highly successful IPO to become the 4th largest investment bank in the United States. This deeply entrenched history bred an illusion of total invincibility. If you worked there, you felt like you were standing inside an indestructible fortress. It was literally every finance graduate's ultimate dream. Bulletproof, or, well, so they thought.
Section 2. The 32-to-1 bet. The financial poison.
Beneath that supposedly bulletproof history, a fatal, highly risky business strategy was quietly brewing in the early 2000s. The tension was secretly building far away from the eyes of the regular employees. Around 2003 and 2004, the firm just stopped acting like a cautious century-old bank. Driven by this relentless pursuit of astronomical yields, they began aggressively accumulating real estate assets. They bought up mortgage lenders and dove headfirst into subprime mortgages. Now, subprime mortgages are highly risky loans given to borrowers with extremely shaky financial backgrounds. Wall Street would then take these risky mortgages, package them together into tradable securities called CDOs, and sell them off. The greed was absolutely intoxicating. By 2007, they underwrote more of these than anyone else, building up a massive, toxic $85 billion portfolio of real estate assets. It was essentially a ticking time bomb, filled with assets that were practically impossible to accurately value.
To really understand this massive Wall Street gamble, let's compare it to something we all know: buying a home. When a traditional home buyer purchases a house, they usually put down about 20% of the total price in cash to secure the loan, right? It's a buffer, it protects you. But this investment bank, to supercharge their revenues and maximize those massive end-of-year bonuses, they borrowed heavily to buy up all those subprime mortgages. They effectively put down just 3% of their own capital for their investments. 3%! That meant they were leveraged at a staggering 32-to-1 ratio. They were borrowing $32 for every one single dollar they actually had sitting in the vault. Being leveraged 32-to-1 means that a mere 3% drop in the housing market doesn't just hurt them, it instantly vaporizes every single cent of their own capital. The margin for error was virtually zero. And then in August 2007, the US housing market finally began to correct. Values started to slip. The poison was officially in the bloodstream.
Behind closed doors, utter panic set in. Insiders confessed that the fabric of what they had built was visibly cracking, with one executive admitting the stress literally made them feel like they wanted to throw up. CEO Dick Fuld was growing increasingly desperate. On June 11, 2008, senior bankers gathered in his private mahogany-paneled dining room, demanding a change in leadership to appease a rapidly terrifying Wall Street. The firm announced a massive $2.8 billion loss, and their stock plummeted 75% in a single week in September. Yet, while the executives were sweating bullets and frantically trying to spin off commercial real estate assets to save their own sinking ship, the ultimate betrayal was already underway. The rank-and-file employees were kept entirely in the dark. A manager literally told the staff, "We're not going bankrupt, get back to work." Everyone was just playing out the act, analyzing spreadsheets for a ghost ship.
Section 3. The Frantic Final Weekend. A thriller countdown. Okay, so it's Friday, September 12th. The clock starts ticking in a breathless, high-stakes countdown inside the concrete fortress of the Federal Reserve Bank of New York. The heads of Wall Street's biggest banks are summoned by the Treasury Secretary. Step 1, the government, facing intense political backlash from taxpayers who are just sick and tired of bailing out billionaires, flat out refuses to use public money to save them. They tell the competing banks, "Figure it out yourselves." Step 2, a potential savior, Bank of America, gets cold feet after opening the books and realizing just how incredibly toxic those assets really are. Their CEO literally stops returning calls and defects to buy Merrill Lynch instead. Step 3, the final, desperate lifeline is the British bank, Barclays. They actually want to buy the firm. High fives are happening in the boardroom, but suddenly, British regulators step in. Under UK law, Barclays needs a shareholder vote, which would take weeks, and the US government completely refuses to guarantee the massive debts in the meantime. Just like that, the deal is completely dead. The clock officially ran out. At exactly 11:50 p.m. on Sunday night, we are talking just minutes before the midnight deadline. With zero buyers and a mind-blowing $619 billion in debt, the executives were mandated to file the largest bankruptcy in human history. CEO Dick Fuld, who associates said believed zero was never an option, was completely defeated. The unstoppable 158-year-old titan was officially dead. Section 4. The infamous walkout. Complete betrayal. And this, right here, is exactly how we end up back at our mysterious, tragic Monday morning where thousands of employees walked straight into an ambush. The contrast is absolutely heartbreaking. Take Jack Reynolds, for instance. He was a graduate trainee who had only been on the job for exactly 1 week. 1 week! He walked out of the London office holding an umbrella and a rugby ball, his dream job instantly vaporized. He said, "My career has been screwed. No one is happy, everyone is upset and down, but they've just got to get on with it." Another employee mentioned how everyone was clearing their desks in total shock, wondering if they'd even get their final paycheck to feed their families. While the top executives had made reckless, highly leveraged billion-dollar bets in secret boardrooms, the brand new graduates and 20-year veterans alike were the ones suddenly out on the street, carrying their entire lives in cardboard boxes.
Section 5. The Unequal Aftermath.
You see, the crucial point we have to make here is that the fallout of this massive collapse was fiercely, painfully unequal. On one side, the global markets bled. The FTSE 100 in London dropped so hard that £50 billion was wiped off the value of Britain's top companies in a single day. Over $46 billion of the firm's own market value simply evaporated into thin air. But for the executives? Well, many of the top brass weren't treated like pariahs at all. They simply redeployed. Thousands of the investment bankers were quickly absorbed when Barclays and Nomura bought up the lucrative remains of the business. Even the CEO eventually went on to run a private wealth management firm. They just kept their prestigious careers in finance moving right along as if nothing happened.
But for the operations staff, the secretaries, the event planners, the IT workers, it was a deeply tragic, entirely different story. Former Senior VP David Ambinder summed it up perfectly. Nobody wants to be in a situation where you work for 25 years and your retirement fund goes to hell because of other people's decisions. The regular staff didn't just lose their income, they lost their entire life savings. So much of the regular staff's personal wealth and retirement funds were tied up in the firm's stock that plunged 93% in a matter of days before hitting absolute zero. They pay the ultimate, devastating price for decisions they had absolutely no part in making.
So I want to leave you with this provocative thought. The government allowed this titan to fail to prove a point, right? But then they immediately turned around and bailed out other massive financial institutions. If the eventual bailouts proved to Wall Street that bad, risky behavior gets rewarded with a taxpayer safety net, has the financial system truly learned its lesson?
Or did we just teach them that as long as they are too big to fail, they can keep making wild 32-to-1 bets with other people's money? Are we just sitting here, right now, waiting for the exact same history to repeat itself? Think about that the next time you swipe your badge on what feels like a completely normal Monday morning.